I want to start from the overall market view. I mean, recently, in US, CPI was announced and there was a crash in the markets. Are we going to sell again all the CPIs and another rate hike? What do you think about this?
Well, first of all, Ersoy, thank you for having me on your show. I would slightly disagree with you on the wording of crash. What is happening, in our opinion, is something completely natural, which is a downward movement in stock markets, which is on the back of CPI numbers and interest rates going up. We do not think that inflation has peaked yet, because if you dig into the inflation numbers, they did moderate a little bit recently on the back of lower energy prices. However, everything else is much, much higher. We are today in a price-wage cycle, which is quite bad. And we do expect the Fed to become more aggressive, not only on the interest rates. There's another tool that they have not used yet, which is reducing the Fed's balance sheets. Back in May, they said starting June, they will reduce their balance sheets by $47 billion each month. And then as of September, $94 billion each month. They haven't done any of this yet. And this has a much bigger effect on markets than interest rates.
Very interesting. Okay, at this time of conditions and we see lots of volatility, how should the portfolio managers or advisors or investors should react to this? Should they seek for the yield or should they protect their money? What's your opinion about this?
Well, as a professional investor, we look at risk versus return. So we look at the volatility of the market today, up and down, substantially higher volatility than usual. Are we sufficiently compensated by US stock markets? The answer is clearly no. That's why back in April, we advised our clients to increase their cash balance to 40% of their portfolios and reduce substantially their US stocks exposure to only non-cyclicals. Now we have increased the cash allocation to 50%, cutting US equities and looking at different markets. Private equity, convex strategy on structured credit like CDX and iTraxx. These are very complex strategies that protect you from the market. They are non-cyclical. And diversifying from a geographic perspective, rather than look at US and Europe, looking elsewhere.
Okay, I was going to ask you the same question. I mean, okay, when there is volatility, there is opportunity. But there are different asset classes, different geographies or developed markets, emerging markets. So currently, what are you recommending to your clients?
Unfortunately, the two largest developed markets, US and Europe, are in trouble. So we advise to stay away on listed markets, stocks, and obviously bonds, because interest rates are going up, bonds will suffer. And that's why today we're looking at other markets. 3 markets I could suggest. The first one is the GCC and oil-selling countries. These are benefiting a lot from high energy prices, obviously. Second, you have countries like Brazil, for example, which benefits a lot from high energy prices. And Brazil is a country that is continuously boiling and changing. And there's a third country which is now emerging again, which is Turkey. Turkey today has many, many opportunities that we're looking at and that we're investing in.
Okay, I want to get into more detail because our audience is in Turkey. Now, of course, there's high inflation in Turkey, currency devaluation. We are going to elections next year. It's a tough times, but is there opportunities for the investors?
So generally, a rule of thumb, we stay away from emerging markets that have their currency not pegged to the dollar. And obviously, Turkey is one of them. The currency has devaluated. So if we start with the stock markets have done well. It's time to book profits on what has been done on the stock markets. And depending on the entry point, maybe do some rebalancing. The first one is to make switches within the portfolio. So without naming companies, for example, for banks, move away from banks with weaker balance sheets and go for banks with much stronger balance sheets and lower loan-to-deposit ratios. Second, look at private markets and VC. Today, Turkey, and it's mind-boggling, has the largest number of deals on VCs in all of emerging markets. It's really up there if you look at the graph of the number of deals. Turkey today is exporting technology and importing technology. Today, on gaming, on lots of software development is happening in Turkey, and these are big opportunities of investments. And the last thing I'm going to say, as an inflation hedge, particularly for Turkey, it's not gold, it's not Bitcoin, it's nothing but VC and private equity. It's the best inflation hedge ever.